Well, Jerome Powell, I tell you what, I have not seen a guy with the record that he has. I can't remember exactly what it is, but I believe out of all the times he's spoken at the Fed meetings, I think there's only one time the market's ever finished positive when he's spoken. He has got a terrible record. You'd think someone at this point now would go, listen, Jerome, we're not going to let you go up on this stage because you keep going up, and every time you go up, that market, you keep crashing it, mate. So let's not let you go on this stage. He has got a terrible record, and that record continues once again. He did a great job of tanking the markets. If we have a look at the Nasdaq here, you can see the market was slowly ticking downwards as the day went on, waiting to see what the Fed was saying. And then we actually had the initial statement from the Fed, which was actually received really positively, and it looked quite positive in the way that it looked like they could potentially see a bit of a reduction in the rates and how much we have been hiking up these interest rates. And you'll see here the stock market actually popped up quite well. And then Jerome Powell came on, he did his question and answer session, and you'll just see the more that went on, the lower and lower that went. And we ended up with the Nasdaq closing down 3.3%, but on the day, or from the highs to the lows, it was actually a 4.2% swing. If you look at the S&P 500, pretty much mirrors the Nasdaq, just not as aggressive as you would expect. But same again, that was nearly 3.3% swing. And you look at every stock chart was very similar to what happened yesterday. Meta looked so much like the indexes, that was a massive swing. Even Microsoft got caught up in this. You look at Google, Google had that was an ugly one for Google. And just overall, you can see the impacts that Jerome Powell really had on the market and what the Fed had on the market. So this article from Seeking Alpha, I feel like sums it up quite well. So they said the markets initially had trouble deciphering the signal sent by the Fed Jerome Powell as the US Central Bank announced its fourth consecutive interest rate increase of 75 basis points. I don't know if that is so true. We can see here from the markets, they initially looked at that as quite a positive impact, and it looked pretty okay from that point of view. And you'll see here, it said that in the remarks delivered following the policy announcement, Powell signaled that a slowing of the rate hikes could come in the near future, possibly starting at the central bank's next meeting. However, he also noted that we have more ground to cover and pushed back on the idea that the Fed has been too aggressive, adding, I don't get any sense that we have over-tightened or moved too fast. Wall Street is now generally expecting the Fed to ease off the gas and at its next meeting scheduled for December. By the way, we still have one set of inflation data, I believe, to come out before that meeting. So hopefully that helps the market and what potential decisions that the Fed could make. The markets are pricing in a 55.7% chance that the Fed will raise rates by 50 basis points. So you can see here the majority at the moment are expecting the Fed to start slowing down the interest rate hikes in the next meeting, which is very key. With a 4.7% chance that the increase will be as small as 25 basis points, I don't think at all we'll have that, then 4.7% that are expecting that 25 basis points hike. I think I'll have been a little bit too optimistic there. The probability of another 75 basis points rise currently sits at 39%. These odds suggest the market read Powell's remarks as slightly dovish. A day ago, prior to the Fed announcement, markets had put the chance of a 75 basis points increase at the December meeting at roughly 50-50. So you can see here, Wall Street actually took this in a way that potentially now the Fed could look at starting to slow down them interest rates that they are, or the interest hikes that they're currently having on. Now the thing is, as you can tell here, there was a lot of Jerome Powell has been for very much recently. He's kind of covered his back. He kind of covered his back here, going, you know what? If we need to be a little more aggressive and we come in with another 75 basis points hike, you can't say I didn't warn you. However, he left the optimism there of like, potentially, if we're seeing things starting to move in the better direction of the inflation rate, because we know that can take, a few months to come into the impact of our hikes, and potentially we see the economy potentially deteriorating a little bit, potentially that goes, okay, we'll just slow it down a little bit. So he left it open, and you can see here the markets on Wall Street took that as a little bit dovish, but it basically means that we're going in now with a 50-50 shot, and potentially that meeting in December can probably be a big turning point for us, because if we're hit with another 75 basis points, you can see how the market would react quite negative to that. And if the market actually sees, okay, the Fed is starting to bring them, that hike up a little bit down now, obviously the market would, react pretty positive to that. So that's obviously a key date in December that you'll have to write in your diary. And you'll see here the Fed will get the inflation data from October in November, and actually I think they might just actually get the November data in December. So actually when they meet on the 14th of December for the last one of the year, then potentially they'll have at least one more set of inflation data and potentially a second set of data, and that will ultimately, I believe, be the key driver of what will make the Fed's decision. If we carry on going on this downtrend and we start moving lower down, I think that will potentially tilt towards the Fed, reducing the amount that they are increasing at the moment. I think if we start seeing inflation maybe not coming down as quick as what we have seen, or as what it should be, I think that could be, one of the key turning points. But I think one of the big things that has happened recently is when we look at earnings, or even if we look at the economic data, if we look at the jobs reports at the moment, if you look at the economic data, everything coming out is that we know there's a slowdown, but everyone said that this was the worst recession since 2008, or it's going to be the greatest recession that's ever been, and it's not happening. The economic data out there at the moment is going, there's a slowdown going on, but it's not terrible. And you look at the job data, that's one of the key things. At the moment the Fed wanting to increase interest rates, and it's going to hurt the economy a little bit, but they just want the economy to slow down. They don't want the economy to, absolutely crash. They don't want the economy to go absolutely bonkers. They just want the economy to slow down a little bit as they control the inflation. And if you're from the Fed's point of view right now, they're winning. There's no doubt about it. They've slowed the economy down. We've seen it in a few companies' earnings. We've seen it with a few things that are going out there. But the job growth, the job numbers are still holding okay. Sure, the economy's slowing down, but when we look at the companies like UPS or any other sort of companies, there's a few companies at the moment that are getting hit a little bit heavier. But majority overall, especially when you look at in this earnings season, most of the companies out there have come out with, it's okay. Whether you look at like the payment companies like Visa and MasterCard the other day, they basically came out and they were like, yeah, things are still looking okay. Whether we look at the likes of Bank of America, they basically went, people think there's a recession going on, but we can see people are still spending. We look after their accounts, we can see people are still spending. So from the actual Fed's point of view, they've basically got what they set out to achieve. Inflation is starting to come down. They've slowed the economy down, but it's not exactly got to the point where it's entering a massive recession. But the big thing now, I think, what's going to, obviously drive things is that they want to get this inflation down, and then we'll have 2 more points where they get a data from. And I think that will ultimately, see where we kind of, come out in that December time frame and where we move. And I think that will be a key driver for the markets, because if I finally have some daylight of going, okay, the Fed's actually calming down now, that will be, I think, a big thing for the Fed here. So my overall thoughts is not much has changed from today, and I don't think we have that much new information. My big thing is that I think the markets were a little bit crazy to react. I think this kind of reaction here was a little bit bonkers in the markets, because I feel like there wasn't that much disruption caused here, and then it decided to tank. And once again, it's a bit frustrating to see, recently we've had a lot of companies, doing quite well and ticking up nicely, and it can be a bit frustrating. I saw DraftKings that was having, a really nice day, and then it just went boom off because of the Fed, and it was a little bit frustrating to go, it doesn't really make that much of a difference, and the company's performing absolutely amazing, but it's frustrating to see your share price go down because of this. However, in the long term, nobody will remember this. No one will remember the 2nd of November when Jerome Powell didn't really give too much away whether or not he's going to slow down the interest rate hikes from 75 points down to 50 points. Nobody will remember this day in 5 years' time. What people will remember in 5 years' time is what you bought your shares at and what progress did that company make, and did it make good progress, and if it made good progress, your share price will be higher and you'll be very happy in 5 years' time. And if your business made bad decisions and your business didn't do well in the next 5 years, your share price is going to be lower and your company didn't perform and you have a bad return on your share price. And that will be the ultimate decider if your investment did well. Not today on the 2nd November with Jerome Powell saying this. And that's the big thing overall that I think is the key thing to kind of remember anyway. So I hope you enjoyed the video anyway, guys, just talking about this for a little bit, because it was a key market mover today, or yesterday should I say, by the time this video goes up anyway. So I hope you enjoyed the video. Smash the like button. If you're new around here, subscribe, and I'll catch you in a bit.